Well, new data showing that mortgage demand edged higher for 30-year fixed-rate mortgages in the last week. According to the Mortgage Bankers Association, the rate on a 30-year fix rose to 7.67%, but the big move in demand was for adjusted-rate mortgages, which jumped by 15%. Joining us now is Mike Fratantoni, a Mortgage Bankers Association chief economist. Mike, thanks for being here. What do you think accounted for this increased demand, not just for fixed rate, but for those ARM mortgages?
Yeah, well, thanks for having me. And as you said, we really saw a difference in the volume last week where overall volume was up just a bit, but we saw that large 15% increase in people applying for adjustable rate mortgages. As you noted, the fixed rate at 7.67, that's the highest we've seen in 23 years. But because of some of the moves in the Treasury market, the ARM rate was down to about 6.3%, so down about 0.16% on the week. And people respond to price changes. It is very, very challenging to find affordability in today's market, given how much rates have gone up. But one way that borrowers can adjust is by looking for an ARM. And we saw in last week's data, we're up to a 9.2% ARM share. That's the highest we've seen in a while.
And Mike, your organization sent a letter to Fed Chair Jerome Powell recently. Why did you send that letter, and what are you asking for?
Yeah. So obviously the housing sector is one of the most interest rate sensitive sectors in the economy. And we were just weighing in with the view that we think the Fed's short rate increases, getting the Fed funds rate up to between 5.25 and 5.5, that is sufficiently restrictive to bring inflation down. And we're honestly more worried now about this additional pain in the housing market, given how much activity has slowed.
Mike, on that point, Peter Bukvar, Chief Investment Officer at Bleakley Advisory Group, here's what he told his clients about that letter. I'd love your reaction about this. Bukvar said, while I fully understand their concerns, I don't recall these groups during the mid-2000s calling for the Fed to raise rates as they were stoking that decade's housing bubble. And I don't believe they were telling the Fed to stop QE, including the massive buying of MBS mortgage-backed securities in 2020 and 2021, and to raise rates as home prices were leaping by 40% in 2 years. You think Peter Bukvar has a point there? What's your reaction, Mike?
I think he's a bit off base. The real estate finance industry is very much reliant upon stable long-term rates. And those stable long-term rates are dependent upon the Fed doing what they do best, which is keeping inflation low while trying to maximize employment. I would say he's directly wrong. Actually, in 2020, we did ask the Fed to stop buying MBS to the extent that they were, because a lot of lenders were getting enormous margin calls based upon the swings in the market. So our sense is, we want stable rates. Obviously, they can't be lower than can be sustained over time, and we need inflation to be low to keep those long-term rates as low as they can be.
Is the stability approaching, Mike? Are we getting any closer to stability? And what do you think is a sustainable long-term rate that can still coexist with a robust housing market?
Yeah, I think it's been really interesting just within the past week. You've had a number of Federal Reserve officials note that the balance of risks now really are leaning more towards concerns about weakness in the economy, that the spike in long-term rates we've seen over the last 6 weeks plus is really putting a lot of strains into the economy. Absolutely the housing sector, but other sectors as well. In terms of where we're headed over the longer term, we're going to be releasing our new forecast on Sunday at our annual convention. The Fed themselves have said that a neutral Fed funds rate is probably somewhere between 2.5% and 3%. That probably means a 10-year yield around 3.5%. And if the spread between 30-year mortgage rates and 10-year Treasury rates could get anywhere close to normal, that means a 30-year mortgage rate of, call it 5.5%. So that's where we think we'll get to over the next couple of years. We're in just this very, very stressful point right now at 7.5% plus on a 30-year mortgage.
So your outlook, Mike, for the U.S. housing market, walk me through it, because supply side, limited inventory, demand side, as we're talking, affordability's been crushed. What breaks that? Does it just enough people, demand just simply punch through that? Enough people have life costs and they just have to pay up for it? How do you think we move out of this?
Yeah. So we talked about how some borrowers are adjusting by moving to an adjustable rate mortgage. That's one dimension. You also see people able, because of maybe a hybrid work schedule, to look for properties a little bit further from their work, right? And so that's one way to bring costs down. They also might look for a condo or a townhouse instead of a detached property. So all of those ways are ways in which borrowers can adjust. Our outlook for housing really is very much dependent on the path for rates and the path for the economy. We think the economy is likely to be in recession in the first half of next year, but a fairly mild one. And sort of the net of somewhat lower rates and a somewhat weaker job market, we think it'll enable some additional existing properties to be listed, which will not eliminate, but make the inventory situation just a bit better. So we're looking for modest growth in home sales over the next several years. One thing we've certainly seen is that given the very strong job market, delinquencies are extraordinarily low, actually a record low in our most recent data point. And even with some increase in unemployment, we still expect the housing market is going to be strong in terms of performance of homeowners continuing to pay on their loans.
Mike Fratantoni, thank you so much for joining us.
Thank you.